Good morning, everyone. I think that's just gone 11 o'clock, so we'll kick off and start there. Welcome to the first of two webinars being jointly presented between myself, Ian Parker, who's Director of Whitley Stimpson, and Angus Aston, who hopefully you can see in the side window, and who's a Director of Wise Investment. The webinar this morning will focus on pensions and particularly the recent rule changes around the annual allowance and the lifetime allowance, hence the title, Making the Best of the New Rules, which we felt was more diplomatic than our alternative title being Pensions, Another Fine Mess. I'll end the comparisons to Laurel and Hardy there before Angus stops talking to me. I think with that, Angus will give a brief overview of Wise Investment.
Thank you, Ian. Yeah, right. Well, as those of you who've attended before, we were founded in Chipping Norton in 1992 and have stayed resolutely local to that area, sort of 31 years on. We're an employee-owned business, so our staff have a sort of direct stake in the success of the business, and it means the better we look after our clients, the better it is for everybody. And in particular, we look to have long-term client relationships because financial advice, investments, pensions, and so on are by their nature very long-term. And that's the nature of us. We do, in the main, pensions and retirement, managing investments, as it says here, and inheritance tax planning and sort of protection around that where necessary. Yeah, that's us.
Brilliant. Thanks, Angus. So just again, giving everybody a brief overview of Whitley Stimpson, and I'm conscious that many of you will have joined us before, so we're well aware of this. We were founded in Banbury in 1931 and have recently expanded, now having 4 offices across the Thames Valley in Banbury, Bicester, High Wycombe and Witney. We offer the complete range of services that you'd expect from a regional firm of accountancy services. So we offer tax planning, auditing, payroll, and all of the usual compliance aspects, so annual accounts, tax returns, etc. We've grown steadily over that time, and we now have about a headcount of just about 95 people. So we like to pride ourselves on the fact that we're big enough to give the holistic advice, but still small enough to care. And I think that's where we're very well aligned with Wise. As Angus said, it's about long-term relationships that we build with our clients, and we're very proud of the fact that many of our clients have been clients of Whitley Stimpson for decades now, and long may it continue. So the general format for today is going to be this webinar will be approximately 40 to 45 minutes, and then there'll be some time at the end for a Q&A session. The team have put a message in the chat section just explaining how the Q&A works, and please do use the Q&A functionality within Zoom webinars. We will do our best to answer as many questions as we can, dependent on time. But anything that we can't get to, if you could just leave your name, we will try and come back to you after the webinar with a separate email. We will aim to wrap up well within the hour and get you back to the beautiful sunshine before the winter weather really hits in. So with that, we'll crack on. Up on the screen at the moment is a disclaimer, all of the usual things. As it says there, the content of the presentation represents Angus and mine personal views. Don't worry, we will keep off our soapboxes, but it shouldn't be construed.
We'll try.
We will try. As financial or investment advice, and all information is based on our current understanding of law and practice, which you'll see as we go through the webinar is a very important thing to note. And as it says there, past performance is not an indication of future performance. So
yeah, that middle paragraph is particularly relevant for this content, as you'll see.
It is, and you'll see why we were very tempted to use another fine mess, I think, as well, weren't they, Angus? So kicking off then, just a brief sort of recap and overview on where we are with pension contributions. So starting off here with personal contributions. I'm not just going to read the points on the slide. I think most people are fairly comfortable with this now. The key here is that up until April 23, the gross contribution that somebody could make, and that is an important distinction. I think, again, most people are comfortable that with the majority of contributions into a personal pension fund, that you do get some tax relief through the pension contribution, and more the government add to the pot as well. So gross contributions were the lower of 3,600 relevant earnings or 40,000. The key point there is relevant earnings and the definition around that. That's the one that people sometimes get caught out by. Relevant earnings are earnings, basically. So it's sole trade income, partnership income, and employment income. And the employment income can include payments in lieu of notice and other payments received by way of an employment. But the key here is it's not investment or passive income, so dividends don't count towards that, nor does income from most rental properties, with the exception of furnished holiday lets. The headline change in terms of annual contribution limits from the budget back on the 15th of March was that the annual allowance threshold increased from 40,000 to 60,000. And Angus will cover in a bit more detail what that might mean for you. But that was the headline change in terms of individuals making annual pension contributions. There are also some separate tapering rules which reduce the amount that very high earners can contribute into a pension. And that they kick in for people with an adjusted income over 260,000. Again, we could do an entire webinar just on those tapering rules.
Yes, the people might find themselves falling asleep towards the end of it.
I think they might. Certainly, when I read through the legislation, I tend to nod off halfway through.
Shouldn't be saying that.
So yeah, we won't go into too much detail. The likelihood is, if you're impacted by that, you will already know. Those rules have now been in for several years, and so the chances are, if you are impacted by those taperings, you will already be aware of that.
So basically, the allowances were made more generous, which was a bit of a surprise. But where it sort of derived from was the clamour over NHS pensions, particularly doctors who are working overtime, finding themselves actually worse off as a result of working more because the additional pension contributions tipped them over the allowances. So that was the change in the allowances was there to sort of offset that, and now it's being used as an argument in the ongoing disputes over doctors' pay. But anyway, that's not for us to worry about. Yeah, sorry, Ian, carry on.
No, not at all. Thanks, Angus. So then company pension contributions. So the key difference here is that if a contribution is made by your company, whether it be yours, if you're the main shareholders, or if it's your employer, those contributions don't benefit from the additional tax relief that the government would make on personal pension contributions. So but the trade-off is that the relevant earnings and the 3,600 lower limits don't apply here. So actually, quite commonly, we will see people who run their own businesses making quite large pension contributions from their companies into their pensions. And the benefits of that are that it's not taxable on the individual as income, but it is tax deductible for the company. And with the now newly increased rates of corporation tax now being at 25%, that's quite an attractive corporate or company tax planning strategy, you do, and I've put it on there as the bottom point, you do need to sort of watch the wholly and exclusively tests. I think Angus and I will talk about that in a little more detail later on.
Right. So weighing in, what has continued under the new rules is the concept of carrying forward, which is if you have not used all of your allowances in any of the 3 previous tax years, you can add them to this year's allowance. That's provided that you were already a member of some sort of pension scheme in those earlier years. Without sort of delving into too much detail, the allowances were 40,000 for each of the last 3 years and now 60,000 this year. If you've made no pension contributions in this time, then you've got this year's 60,000 plus 3 lots of 40,000, giving you a total sort of theoretically, if you had the resources available, of up to £180,000 pension contribution this year. Yeah,
and that's really where you need to be a bit more careful, and really where my point on the last slide comes in with regards to the wholly and exclusively test. So obviously, if it's a company that's making this sort of quantum of contribution, and you want or expecting to get corporate tax relief from that, the revenue could have a look and say, is this contribution necessary and reasonable for the business? Now, in reality, and never say never, we haven't seen any challenges from HMRC along these lines, but clearly with the increased allowance, there is scope there. And I think our advice would always be, look at a package in the whole. So look at a combination of what you take as salary, what goes in as pension contributions, and would that be reasonable for somebody in your role if you were working for another unconnected third party? And quite often the answer is actually yes. So, you know, in the main, people will tend to sacrifice some salary levels to put more into their pension, and so the overall package is still not unreasonable. So
yeah,
I
have come across I've spoken to people who've sort of misunderstood and thought, well, aren't I limited to whatever salary I'm drawing from my company? So they might be paying themselves 12,000 a year. And I know I'm sort of slightly repeating what you said, but I have still come across in recent times, oh, I'm limited to 12,000 a year into the pension. That's not the case, and I've yet to come across a challenge by the revenue against any sort of reasonable pension contribution, provided a company can afford it.
Absolutely. And you briefly touched on something there, Angus, but it is quite an important point. To be able to use the carry forward, you have to have been part of a pension scheme for the years that you're trying to use.
That's correct. It doesn't have to be the scheme the pension that you're contributing to. It could be some old, previous work scheme that you had, or anything, as long as you're not new to pension saving or pension accumulation in the UK. That's all there is to it. If you are in any doubt, obviously, on your personal situation, then it's worth having a chat with an advisor or an accountant.
Absolutely. So we've sort of talked about there how pension contributions made by the company can be useful from a corporate tax perspective. And Angus has got a nice table here, which just demonstrates some examples, and there are hundreds of thousands of iterations that you could make. These are just some examples that we've come up with, but that just show the differences between how people could take some money out of a company.
Yeah. So without kind of delving into all the workings, the line that says net amount extracted is what sort of falls out the bottom if you have a company makes a pension contribution for you and has 60,000, or sorry, has 60,000 available to sort of do something with, either pay you more directly into your pocket or to put it via a pension contribution or some combination. So if you just go for salary, which I think a lot of people know is obviously not the best thing to do in this situation, with the employer paying national insurance, you paying national insurance and income tax, assuming you're a basic rate taxpayer, what drops out the bottom is about £40,000 in your pocket, which you might want for particular reasons. But then if you want the cash, the better way to do it would be a dividend payment, or in this case, assuming no other earnings, a mixture of salary and dividend, which gives you that figure of 44,326 when all the taxes are accounted for. If you just purely went for a pension contribution, it would come out of the company without any corporation tax as a deductible expense. 60,000 lands in the pension. So bear in mind, the money's in a pension, not in your pocket, so you can't spend it straight away, which may be a problem. But if you're past the standard sort of minimum retirement age, currently 55, you could, in theory, then take the benefits. In practice, you probably wouldn't. This is for the long term. But if you did, assuming simple situation, no other income, you could end up with a sort of 51,000 sort of net of the income tax that you pay on taking the money out of the pension. However, as pointed out before, you would then be subject to a future limit of 10,000 a year. So this is a bit theoretical. But then if you wanted to mix the two, bit of cash in your pocket, bit in the pension, it's sort of immediately you'd have 50,000 in a combination of your pocket and 20,000 in the pension. Again, bit of tax comes off if you extract the money from the pension at that point. So a lot of detail there. A lot depends on your individual tax circumstance. I think it's quite common for people to remunerate in terms of salary plus dividend, if they control their own company, up to the basic rate, higher rate tax threshold, roughly 50,000, just over. And then if there are surplus funds in the company, it's quite common for then to do pension contributions, assuming that that meets with your sort of general objectives of putting money away for retirement.
Absolutely, and I mean it's a very common structure in terms of what we see day to day. As I said, we've put some examples there. Actually, we do then tailor this to individuals, sort of bespoke situations, and one of the drivers is quite often that people want to keep their income just below the 50,000 basic rate threshold, as Angus has said, because above that you start potentially having to repay other benefits, like, for example, child benefit, and those sorts of things. And actually they can be very useful for people to keep. So whilst this gives some ideas, it just goes to show how many options people do have.
Yeah, just to add, I mean, we focused on what if you've got a company, but if you're a salaried person working for another company, you might want to discuss with them if you're a high rate taxpayer, for example, and you get a bonus. If it's surplus to what you need in terms of income, would your company consider paying that into your pension for you? There may well be a workplace scheme anyway. And particularly if you're earning over 100,000, which may not obviously apply to everybody listening, but if you are, you're losing some of you're losing some or all of your personal allowance as you get up to sort of past 125 odd thousand of earnings. Making a pension contribution can get that back for you, so it's still a pretty valuable thing to do. We will be moving on to the lifetime allowance and the rule changes there, which sort of slightly double-edged, but on the whole are favourable towards pension saving.
Thanks, Angus. And whilst we'll do the majority of questions at the end, we have had a question which I think is very relevant to this point. Somebody's asked the 60,000 allowance for an employed individual. Is that the combined employer and individual, or is that just the individuals?
Yes, so it's the total of all pension contributions wherever they've come from, whether you've sort of reached into your own pocket or had it deducted from your salary, and the employer contribution. So it's the total of the two.
Perfect. So as Angus has said, that's a sort of fairly whistle-stop tour of the change in the annual allowance. But in reality, we weren't blown away when that was announced in the budget. That wasn't the sort of rabbit out of the hat moment. I think the changes to the lifetime allowance were potentially a lot more unexpected, weren't they, Angus?
Well, yeah. So there were rumours circulating the day before the budget, which would then have been whatever, Tuesday the 14th of March or whatever it was, that the lifetime allowance was going to be reset to where it had got to in 2010, which was 1.8 million. That was the sort of word on the grapevine. And there was nothing sort of inkling about what we've just talked about, the increase in allowance. If anything, there was talk about it being reduced because of the cost into the treasury of higher rate tax relief. So it was a bit of a surprise, the thing increasing to the contribution allowance increasing to 60, but not as much as the sort of ripping off of the lid on the value of your pension benefits by the scrapping of the lifetime allowance. Now, that title slide has got brackets soon to be defunct, but actually sort of not quite. It's a bit more complicated, but what's happened, I don't know, we can probably move on to the next slide, Ian. You can probably flip us over, is that the government and, well, the Treasury, Jeremy Hunt, have said, we want to scrap the lifetime allowance, but put a cap on the tax-free amount that you can get from your pension or pensions. And those are the two directives passed to HMRC. And I don't often feel sorry for HMRC, but in this instance, I sort of do, because the actual implementation of that is really quite complicated. So the legislation is being drafted. There's a consultation with industry and interested parties. All of the major pension providers, Prudential, Aberdeen, which used to be Standard Life, and so on, are trying to get their head around the rules and still don't have 100% clarity on actually what it's going to look like. And there's a political angle, which is that Labour have said if they get into power, they will reinstate the lifetime allowance, which is an alarming prospect, whatever your politics, because as an advisor, it just creates a further minefield. It simplifies nothing. But anyway, I hope the banana skin is obvious. Decisions made now could be, under the rules as we understand them could come up and bite us later, but we don't know for sure. So I'll do my best to explain where we're at. Yeah, I think probably let's skip on to the next one. Right, so where we were was there was a cap on the value of your pensions, whether that was income or cash that you received. That had originally started at 1.5 million when these rules came in 2006, increased to 1.8 million, as I say, by 2010. And there it was supposed to stay until austerity came along, and it was gradually stepped down and down and down. And at each step down, if your pension benefits looked like they were going to or did exceed that new allowance, you could protect the previous one with, for the most part, the quid pro quo, the trade-off being that you would no longer be able to contribute. A couple of exceptions. So we now have this mishmash framework of several different types of exemption or protection. And unfortunately, those rules are still with us and will not be going away. In the old days, up to the 15th of March this year, if you'd exceeded the lifetime allowance, there'd have been a tax charge, which might have been 55% if you took the excess as cash in your pocket, or 25% if you left the money in your pension fund to draw income from later, on which you'd pay income tax. As of 15th of March, the LTA still technically exists, but it's now, the tax charge is now 0. So if you were taking benefits now, there'd be still an analysis of your lifetime allowance position, which is a bit of a rigmarole for pension providers, but what drops out the end is you pay no tax. So that's fine. This is while all these details of how you actually write it into legislation that you undo the previous rules is being worked on this year. So it's all nice and simple, lifetime allowance gone.
I'm not sure.
To be replaced with oh, hang on, I'm skipping ahead a bit, am I?
You were a little bit, I think. So I think.
So we were going to look at what happens to your pension when you die.
And broadly,
okay. So this is important. Under the, and this is where there are a few grey areas. Under the old rules, pensions were not, well, old, still some of it current this year. Pensions are not subject to inheritance tax, and if you died before the age of 75, your beneficiaries, which could be your spouse or your children or anyone else, could basically have that fund tax-free. If it exceeded the lifetime allowance, there'd be the usual lifetime allowance tax charge, but then everything else would be tax-free. If you died before 75, but if you died after 75, there'd be income tax payable. It looks very much like, well, it will change from the 6th of April, 2024. And we'll look at that as far as we can in just a moment.
Absolutely. So, and I just think, again, most people will be familiar with it, but if somebody died after age 75 and they passed their pension on and the beneficiary started to draw that down, they pay income tax at their marginal rate. So if you've got somebody who, let's say, earns 60,000 a year as a salary and they start to draw another 20,000 a year from a pension that's been passed on to them, that would all be taxed at 40% in all likelihood. So
that's right. But the critical point was that you had some control. If you nominated your children, even adult children, as potential beneficiaries, then there would be no capital tax on the transfer into their names if they chose to just leave the pot of money alone. It was only when they drew, which could be 20 years later, that they would pay income tax.
Absolutely, absolutely. But as you say, this is almost certain. Nothing's entirely certain, but almost certain to change from April 24.
Yeah.
So that then leads us to where we are now, I suppose, Angus, doesn't it?
Yes, it does. So as I've said, the lifetime allowance itself as a principle will be scrapped from the 6th of April, 2024. Say the current tax charge, if for exceeding the lifetime allowance, is 0. And this is where the political angle comes in, because Labour have said they'll reinstate it. We don't know how or anyway what that looks like. Question if your pension benefits are going to exceed the lifetime allowance, should you take them now if you're allowed to, so that you pay 0 tax just in case they come in? That's a real grey area, and it's very difficult to advise upon, because we can't account for what the rules might be in the future. But there it is. There's a bit of political jeopardy in there. So basically, it doesn't matter how much income you get from a pension fund or various pension funds, there will be no lifetime allowance test and no lifetime allowance tax. However, the tax-free lump sum that you're allowed, or total of tax-free lump sums, is going to be frozen at £268,275. So this is going to be called the lump sum allowance. And there's another allowance, which is called the lump sum and death benefits allowance, which is that figure on the screen, 1,073,100, which was the lifetime allowance up until April this year. And here's our regime of transitional protection. If you had that before, then you could have higher allowances than the standard ones quoted on these. So nice and simple.
And that's where a lot of the uncertainty is, because I think my original take when these changes were announced in the budget, and probably in early as the first raft of detail flowed through in early April this year, was that if you'd got protection, transitional protection at, let's say, I think the sort of 2014 or 15 rate, 1.5 million, actually one of the big benefits of that was that your 25% tax-free based on 1.5 million protected would be 375,000.
Yeah.
And I'd originally understood that if you were to make further contributions and potentially invalidate your protection, you'd then potentially just be capped at this new lump sum allowance of 268. But the more detail that's come out, that's not necessarily the case anymore, is it, Angus?
Yeah, so that's what we think it looks like, and that's what the industry thinks it will look like, waiting for the final legislation, as I say. So under the old rules, if you had protection, you then made a contribution, apart from 1 or 2 exceptions, you would lose that protection. And I have heard of people making a grave error. They've made a £5,000 pension contribution, and suddenly they've been in for, until now, they've been rescued. They've been in for a massive tax charge on their pension fund as a result of putting in a relatively small amount of money. It looks like that you will not, in most cases, not invalidate the protection that you have by making a further pension contribution, but you will still be subject to that tax-free cash and that lump sum on death limit. Okay. So this is where, I mean, we cannot possibly go through all or even any of the potential permutations. Specific advice will be needed. My instinct says wait until we actually get the final rules. And if you're worried about political risk, it doesn't look like there'll be an election, he says, guessing, until at least autumn next year. So there'll be sort of between April and October, as it might be.
You're a braver man than I am, Angus.
Enough said. I'm not going to make any predictions about that. Yeah, so let's move on, shall we?
So that then,
Right. So briefly, I think this is probably obvious now, but if your limit on tax-free cash is £268,275, it will be the accumulated number of tax-free amounts that you've received. So whether that's from an occupational pension scheme, your standard pension. So you could have pensions worth 2 million. For the sake of argument, you will be limited to £268,275 of tax-free cash. And if you've got a multiple range of schemes, you're limited to 25% from each one. So that's still broadly the same rule as it was before. So you can't say, I've got a £100,000 pension, great, I can have all of that tax-free cash because it's less than 268,000, 25,000 on a £100,000 pension fund.
okay. And then
yeah, nothing more complicated on there.
And then the lump sum and death benefits allowance.
Yeah, okay. So this says that when you die, the maximum amount that your beneficiaries can receive free of tax as a lump sum, and I believe, and I'm waiting for clarification, that this is only the case if you die before you're 75. The maximum is 1,073,100, less any tax-free lump sums that you, the member, took during their lifetime.
So if you'd taken the maximum 268,275, that potentially would be sort of nearer 740,000.
Well, it's getting on for a sort of 268 times 3, basically.
Right. Yeah. Fine. Okay.
Some fun. Yeah, pretty much 800 and a bit thousand. Okay. Anything in over that is going to be taxed at the recipient's marginal tax rate. And bear in mind, we're talking about lump sums here. It looks like any income drawn from pensions by a beneficiary will be taxed at their marginal income tax rate, regardless of the age. This is what the next slide says, but we can skip over it. Regardless of the age of the member's death. So that's the contrast with today, where if a member dies before 75, then income is tax-free. So we're reverting back to the rules as they were in about 2015, basically. That's what it looks like.
Fine, which feels a little bit like it's an inheritance tax charge by the back door, but called income tax, because it's, you're not subjecting that excess over the 1,073,100 to inheritance tax, but it will be subject to income tax at the marginal rate, which, as you say, as a lump sum, could quite easily push somebody to be a 40% taxpayer, which is the same rate as inheritance tax.
Yeah, in a way. I mean, you could look at it like that. I mean, I would, I could, as an advisor, I could get on my high horse about sort of taxes on, but the alternative view, and I'm agnostic about this really, but pensions were never meant to be an inheritance tax escape vehicle. That was never the intention. The Conservative government put these rules in place in around 2015, and at the time, I don't want to say I told you so, but at the time I went, that looks really generous, and actually it probably has changed people's behavior. They've sort of, instead of taking pensions, they've probably leaned more heavily on non-pension assets, cash or other investments that they've had, because it tipping the balance in favor of something that's inheritance tax exempt effectively, or at least very much more flexible. So yeah, you could look at it both ways.
Fair enough. You're far more balanced than I am. So we'll gloss over this slide. I mean, that really just
that's basically
what Angus has just said, which is that the 75 age threshold looks like it's going to disappear, and you'll be taxed on drawing pension regardless of the member's age of passing. And then this was really just an administrative point, I think, Angus, more than anything else.
It's still worth. It's not quite as critical, perhaps, in some respects as it was before. But make sure that you're allowed to nominate who your beneficiaries will be of your pension fund, regardless of its size. Make sure that you keep that up to date and reflects your current wishes and your and your spouse's, if you're in that situation, sort of personal financial situation, just to provide your family, as it might be, with as much flexibility as possible. Yeah, that's all that's to be said on that.
Okay. So I think as a sort of roundup, then we're fairly comfortable with the new annual allowance and the fact that you can now put 60,000, subject to the standard rules that have been in place for a long time on earnings and things for individuals. You can put £60,000 into a pension, and potentially, if you haven't done that for the last, or haven't used your pension for a few years but have been a part of a scheme, maximum could be as much as 180,000 at the moment in terms of using the carry forwards. But the question marks really are around the detailed legislation that's still to be finalised on the lifetime allowance. And as with a lot of these things, the devil will no doubt be in the detail.
Yes. Listening to updates from the providers, I say, like Prudential, Standard Life, who have teams of people combing through legislation. They have much bigger resources than we do. They're spotting errors and omissions in what's being drafted and querying and all the rest of it. So that's a good thing. But unfortunately, when a team of technical folk get their hands on legislation, that tends to create more complication, not less. So yeah, we will see where it falls, but this is that hopefully given people a sort of broad picture of where we're at. My conclusion is that pensions are still very much worth having, but I would say that, wouldn't I?
Absolutely. And I won't hold you to this, but are you still quite optimistic in terms of timescales that they will have got the legislation to a workable level by the start of the new tax year?
Well, they've been handed a remit by the Treasury for these rules, the rules to apply from the 6th of April 2024, and some rule changes to apply immediately. So they've not got a choice. There may be, as ever with these things, there may be some unintended consequences that will only become obvious in time, really, as people kind of absorb the impact of the new rules and sort of adjust their behaviour accordingly. So we shall see.
There we go. So I think that finishes off the slides. As I said, almost bang on time, sort of 45 minutes through, which then leaves us a few minutes for some Q&A session. At the moment, we've had one question that I can see, which probably is more up your street, Angus. How does the carry forward actually work? Do you have to call up your pension provider, and is that something that they then have to facilitate via a special mechanism?
No, so in the past, before the carry forward rules existed, which is several years now, quite a few years, the pension provider used to police the amount that you contributed. Now it's down to you, the individual. So if you made a contribution this year of 70,000, for the sake of argument, your pension scheme would probably write to you saying you've exceeded the standard annual allowance. It's up to you to make any disclosures to the revenue via your tax return if you are liable to pay an annual allowance excess charge, which is not very helpful, but that's the situation. But normally what happens is that if you are in the habit of making doing tax returns, you declare this on your tax return. If it's a personal contribution, you're asked the question, are you liable to pay an annual allowance excess charge? But the revenue has a record of how much has been contributed for you, because there's communication between the pension providers and the revenue. So they can pick up if you've exceeded it, they being the HMRC. But ultimately, it's down to you to self-declare, which, as a responsible citizen, you're required to do, because not to do so would be breaking the rules. So it's on you, but there isn't a sort of police force out there to sort of look at your every move.
No,
Sorry, it is a little bit vague, to be fair, but
it is. I think we tend to find, so most people who are making these size of contributions are already, as you said, Angus, within the self-assessment tax regime. I would say probably the majority, if they've got a financial advisor, then if they've got a financial advisor, quite often they will have discussed that with them, and the financial advisor would have done the calculations and said the maximum you can contribute is this much. If they haven't got a financial advisor, quite often we will then pull together a summary, so we've got a record as to what their unused allowance is going forward. So between ourselves, but sort of both parties, we do tend to get it, to have it covered. But as you say, there is no specific mechanism, and it is very much a self-declaration.
Yeah, you and just to say as well, you absolutely need to watch it very carefully if you are this year, or were in any of the previous years, over the thresholds for the tapering of the annual allowance.
Yeah.
Because the thing is, if you make a pension contribution, that affects that tapering as well, so it can get quite the calculations can get quite untidy. I mean, if I was in the government for the day, I'd do away with those tapering rules altogether. But the other thing to say about the carry forward, if you think about the 4 tax years you have to work with this year, and then the 3, so this year and then the 3 previous ones, it works that you use this year's allowance first, and then if you go over that, you refer back to the earliest of those 3 tax years. So because the allowance was 40,000 in the last 3 years, you could put in 60 plus 40, which is 100. And then as the rules work, these next 2 years are available for you next year. I hope that actually makes sense. So you don't have to use all of these carry forward allowances in one go, because you refer back to the earliest of the 3 years first.
And it's a massive if, given the political landscape. But if nothing were to change, based on what you've just said, effectively next year you would be able to go up to 200, then it'd be 220, and then eventually, when we're looking at potentially 4 years worth of the 60, you'll be at a maximum of 240,000.
Yes, assuming you don't actually make any contributions during this time. You've got to detail, you've got to take off if if you're got a workplace pension that's got a tiny amount coming in, for example, you've got to watch out, you've got to sort of account for that, so that you're using some of that annual allowance there. Anyway,
absolutely,
be too much detail.
So someone's asked, do you have to make a tax return specifically for the purposes of the annual allowance, and what if you don't file a return for any other reason? So the short answer is, if you're comfortable that you haven't breached the overall annual allowance, and that's using your carry forward allowances as well, then there is no specific obligation to file a tax return for that purpose. But what we do see is that, let's say, for example, using Angus as an example, somebody's put 70,000 in. If they've never filed a tax return, they may well get a letter arrive, usually 6 or 7 months after the end of the tax year, just saying, we've had contact from your pension provider and can see that you've put this in. Are you comfortable? And you can usually cover it off with a single letter response, just saying, yes, I've considered it. And this is why I didn't feel the need to, basically.
I'm going to come in with a question now to you, Ian. Where you have sort of a high rate, say a high rate taxpayer who just chooses at the end of the sort of towards the end of the tax year, say, to make a personal pension contribution. So they're a high rate earnings income taxpayer, they've got the earnings to justify a contribution, etc. They're going to get, on a personal contribution, automatic basic rate tax relief, which the provider claims for them. What should they do to make sure that they get, if they're not ordinarily doing a tax return because all their earnings are accounted for PAYE, all their tax is accounted for under PAYE, what should they do to make sure that they get the extra high rate tax relief on that contribution?
You really, if you're making this towards the end of the tax year, which is most common, most people will make these typically in February or early March as part of some year-end planning.
Yeah.
At that point, you're so close to the end of the tax year, the advice is that actually we'd just register you for self-assessment, or you could register yourself for self-assessment and then file your tax return as quickly as you can.
Right. Okay, so you would then say, oh crumbs, I'll do a tax return.
Absolutely.
With the help of an expert if needs be.
If you'd made it earlier on in the year as a personal contribution, then actually I'd say give the revenue a call. Be prepared to be on hold for anywhere between an hour and 3 weeks, and get your tax code updated to reflect the fact that you've made that contribution. And then you should find that actually they are able to sort out your tax through your employment income for the rest of the year.
Right.
And just on that, I mean, it's worth noting that, and I think, again, most people it's filtered through now because we're used to the auto-enrolment pension, but we do still come across people who have been enrolled by their employer into an auto-enrolment pension. They are a higher rate taxpayer, but the contributions that are being deducted are coming off of their net pay rather than salary sacrifice. And of course, if that's the case, you only get your basic rate tax relief, and unless you complete a tax return, you won't ever get your higher rate relief. And so it's just worth keeping an eye. And I said I'd keep off my soapbox, but I would love for the revenue to start including the pension contribution boxes or figures on people's P60s, because at the moment we have to ask for usually the marked pay slip to see annual contributions made as well as the P60.
Right.
Make my life a lot easier if they would put the pension figures on the P60, but that is just something to note, that if you are a higher earner under auto-enrolment, you might need to be doing a tax return, even though you might think that actually it's all accounted for through PAYE.
Oh, right. That's a good point. I mean, I will say that salary sacrifice is subtly very beneficial. So if you are in a workplace pension with an employer who isn't offering salary sacrifice, it's worth asking them why not, because I won't go into the details. The only thing to watch out for is it does mean that your contractual salary is reduced. So if you're trying to get a mortgage or something, then that would reduce the amount you could borrow on a mortgage, for example. But yeah, that's something worth looking at as well if you're employed.
So there aren't any more questions. on the Q&A slide that's shown, both mine and Angus's email addresses are shown. If you've got any questions, queries, anything else that you want to ask but don't want to do it in a public forum, please do drop us an email or pick up the phone. Otherwise,
just very happy to have a chat with anyone, sort of without any obligation, just in general. I mean, if you're kind of really looking for specific advice, then we'd have to have a conversation about that. But yeah, please feel free to drop me, or I'm bringing you into this as well, or Ian, a line, and
absolutely.
We have to help.
It goes back to the start. We work in very similar ways, so I could echo that. Please do pick up the phone or drop an email. So then I think it's just to say thank you very much for attending, and a shameless plug. Angus and I are back to do this all again in a week's time, but the next session is on inheritance tax and really how to approach some IHT planning and some common methods that we see to perhaps mitigate some of the inheritance tax implications. So as I say, we have got another webinar next week. Please do sign up for that if you're interested, and hopefully see you then. Otherwise, thank you very much for attending.
Thanks, Ian. Well done.
Thanks, Angus.